All right, so we've gone through how to calculate the amount of withholding on paychecks and how to calculate the amount of Social Security tax, Medicare tax, and all that on paychecks. So when employers, they're withholding those amounts, means it's not their money. They're holding it in trust, essentially, to then be sent to the IRS at some future time. So that future time is determined by how much they owe. The more they owe, the greater the amount that is owed, the faster the IRS wants their money, right? So there are two different schedules that we need to talk about here, because there's the deposit schedule, when amounts are deposited, and then there is the reporting schedule, when they file the returns and report to the IRS what the taxes should be. And that reporting is kind of works like the 1040, in that you're calculating how much the tax should have been, and then you're comparing it with what the deposits were, and hopefully, most times when we're talking about payroll taxes in the 941, those amounts are going to match exactly, unlike with the 1040, where usually they don't match. They're going to be some sort of difference. But it sort of works the same way, where the tax form, the 941, works as a reconciliation to match up with the deposits that have been made. And normally these tax deposits are made electronically, and employers they'll either do it themselves, they'll set up what's called an EFTPS account, electronic filing, I can't remember what it stands for, but the Department of Treasury runs it. Individuals can have these accounts too for paying their taxes. You have to go in and sign up for it, and then they send you a PIN number. It's sometimes it used to be anyway in the olden days, about a 2-week process in order to do it. I don't know if it still is a 2-week process or not, because they would actually mail you out a PIN number. And then once you had the PIN number, you'd go in and enter your own, change that PIN number and enter your password and all that stuff. But anyway, that's how the employers will make the deposits. But what we want to talk about here is more the schedule of the deposits. Most employers will make deposits either monthly or what's called semi-weekly. And if you recall, that semi-weekly terminology is a little confusing. Semi-weekly doesn't mean that the employer makes deposits twice a week. It means that the IRS accepts deposits on 2 days during the week. And if you're a semi-weekly depositor, you're going to deposit on one of those 2 days, right? So, monthly, every employer starts out as a monthly depositor, and that means that they have to deposit the payroll taxes that they collect by the 15th of the month following the end of the month. So this is November 5th. So we just finished October. Right now, employers are calculating the amount that they withheld during the month of October. If they're a monthly scheduled depositor, they'll have to deposit those funds by November 15th. Now, if it happens, just like with every other IRS deadline, if it happens to fall on a weekend or a holiday, then it's going to be the next business day after that. So I think the 15th this year is a Friday. This month is a Friday. So they'd be able to deposit it on the Friday. That's for monthly scheduled depositors. Again, by the 15th of the month following the month end is when it has to be deposited. If they are a semi-weekly depositor, they will deposit either on Wednesday or Friday, and we'll go through how to determine whether you deposit the funds on the Wednesday or the Friday. But everybody, when they start out, is considered a monthly depositor. Like I said, the frequency or the amount that's owed determines how frequently you pay. But what they do is they have this, to determine the amount that's owed, they have this look back period. So they have to have some sort of history of deposits in order to determine how much was owed. Well, when you're just starting out, you don't have that history of deposits. So they just start you out at this point of being a monthly depositor until you have enough history to determine whether that's an appropriate deposit schedule for you. The look back period, what they do is they look back from July 1st. So For this year, 2024, they would start with July 1st of 2023 and look at all the deposits that were made of all the payroll taxes, all the deposits that were made through June 30th of 2024. They're gonna look at the total amount. That would include federal income taxes that were withheld, Social Security and Medicare taxes, both that were withheld and that were owed by the company. So all of that is totaled up. And if they reported payroll taxes of $50,000 or less, then they will stay as a monthly depositor. So during that whole year, if it's $50,000 or less, they're gonna be a monthly depositor. If it's over $50,000 though, they're considered a semi-weekly depositor, and they will stay that way until that look-back period changes. The IRS notifies businesses in November of every year what their schedule is gonna be for the next year. So businesses are getting notices right now, presumably, for starting January 1st, what their deposit schedule is gonna be. And it's based on July 1st, 2023 through June 30th of 2024. So here's an example. This company, they had 37,000 of total deposits during that look back period. They're going to be a monthly scheduled depositor for next year. I already mentioned that. Semi-weekly. So if you're a semi-weekly scheduled depositor, you have to, presumably you deposit those payroll taxes more often. That might not be the case if you only pay once a month though, because when you deposit, your payroll taxes depends on when your pay date is, okay? So if payday is on a Wednesday, Thursday, or Friday, then you deposit the following Wednesday. How I remember this is it starts with Wednesday, and it would be a week Wednesday. So if you paid, today is Tuesday, so you wouldn't be depositing on a Wednesday, you'd be on this schedule. If the payday was Saturday, Sunday, Monday, or Tuesday, you've got to deposit by Friday. So you've got paid today. If the company paid today and they're a semi-weekly depositor, by Friday they've got to deposit the payroll taxes that were withheld for this paycheck, right? So that's why I say if they say you're more frequent, but that's only if you pay more frequently than monthly. Like if you're a monthly payer, then you're still going to be depositing monthly. It's just that it's going to be probably faster than it would have been if you were a monthly depositor. Does that make sense? Because it's all based on when you actually pay your employees, when that payday is. So here's LMNO, pays its employees every Friday. They're a semi-weekly scheduled depositor. So they paid on Friday, so it means by next Wednesday, they're gonna have to make the deposit for all of the payroll taxes that were collected in that previous payroll period, okay? And again, that's the payroll date when the actual amounts are paid, not the end of the payroll period, because that could be different. I already mentioned this. That's the next banking day. Let's see. I don't need to go through that. There are a couple of instances where there's a different schedule. So if employers have a payroll liability of less than $2,500 at the end of any quarter, they can pay the payroll tax on a quarterly basis when they file their 941. If they have I don't know if they mentioned the $1,000. If they owe, no, they don't even mention that, so I'm not going to mention it. So if it's less than $2,500 at the end of the quarter, they can pay it on a quarterly basis with the 941 form. If on any one payday, they accumulate a payroll tax liability of $100,000 or more, this could be a one-off, or it could be a regular occurrence. If that's the case, then they have to deposit by the next business day. So, like there could certainly be instances where an employer is a monthly scheduled depositor, but maybe they pay out bonuses in December. And because of those bonuses, and this isn't payroll liability, this is just the payroll taxes. because of the bonuses, it bumps them up over $100,000 of payroll tax liability. For that pay period, they are gonna have to make a deposit the next payday. For the following pay period, if they go back under 100,000, they go back to their regular schedule. There are a lot of places though that would just normally always be on a next day schedule. You think of the bigger companies, $100,000 of payroll taxes. I mean, I said, I'm sure DMAC is on the next day schedule with all of the employees that it has. So it's entirely possible that companies will always be on a next day schedule if they have that, but if they then go back to their regular schedule on the next pay period if it's under $100,000. Now in that instance, in that example, I said they were a monthly payroll scheduler, but they had one particular payroll that was $100,000 liability. What's gonna happen is their next look back period, it's gonna make them a semi-weekly depositor because that's obviously more than $50,000. Just that one payroll was more than $50,000, right? Let's see, what do we have here? I don't think we need to do that. All right, so what if you don't pay on time, or what if you don't pay enough? You know, what if you calculate it wrong? Well, obviously they're gonna have penalties because it's the IRS. There's no free rides. So penalties, and they get larger the later you are. And I will tell you, this is the one tax, I would always tell clients when they came in, if they were starting a business, that if you're gonna, don't ignore any of your taxes, but if there's any tax that you cannot ignore, it's payroll taxes. Because they will completely rake you over the coals with regard to payroll taxes. They will throw people in jail over payroll taxes. They got a little bit more patience for income taxes and things like that, but for payroll taxes, they don't, because it's not the employer's money. It doesn't belong to them. They're holding it in trust. And there are a lot of employers out there that get themselves in trouble. They'll collect the taxes and then they'll run into a financial issue and say, well, let's just use this payroll tax money and then we'll make it up a little bit later. And then they get themselves into a bind and they don't have the money to pay their payroll taxes. It is a big no-no. And so you can see the later you are, the higher that penalty is. So 2% if it's made 1 to 5 days late. So even 1 day late, they will charge you a penalty for that. Now usually they'll allow you to be, they will abate a penalty like once every 3 years. And especially when you're just starting out, if you didn't know what you're doing, but you only get one shot. That's once every 3 years. So you can't make too many mistakes. 5%, and this is of the tax that's due. That percentage is based on the tax that's due. 6 to 15 days late, 10% for deposits made 16 or more days late, but before 10 days from the due date of the first notice the IRS sent asking for the tax due. 10% penalty if electronic deposit is required but is not used. 10% if deposits are paid directly to the IRS, paid with the return, or paid to an unauthorized financial institution, and 15% for amounts unpaid more than 10 days after the first notice sent asking for the tax due. So usually they're pretty on the ball with sending out notices. Like when it's due, they usually are pretty quick about getting those notices out. At least in my experience. I haven't done payroll for, what year is this, 2024? It's probably been 7 years or so. They were on the ball then. Now IRS has gone haywire as far as efficiency. I mean, they were going haywire then too, but even now so I'm assuming though, I mean, they've got apparently such a backlog, but I'm assuming they're still pretty much on the ball with getting those penalties out. All right, so that's for the deposits. Any questions? So you want those schedules, monthly deposit scheduler, semi-weekly deposit scheduler, next day deposit requirement, look back period, penalties. So that's pretty much a summary of what we just went through. All right, So let's talk about, so that's the deposit itself. Now we want to move and talk about how to report the amounts that are due. So the 941 is the form that is filled out and used to report. It is due on a quarterly basis. Doesn't matter how much you owe, it's always going to be on a quarterly basis that has to be submitted. There are some minor instances where if it's a really small amount that's due for the whole year, you can file a form on once a year in January for the entire year, but that's very, very rare. That it's like, it has to be less than $1,000 that you owed for the whole year. But even if you don't owe any money, you still have to file the form so that you're telling them you don't owe any money. It is due by the end of the month following the quarter. So first quarter ends March 31st, 941 has to be filed by the end of April 30th. Has to be postmarked by that time. There are ways as well to electronically file these Form 941s, but I think you can still file it on paper if you choose to do so. So, yeah, so well, here's an example here. So, you have to indicate the number of employees that were working there during a particular day of a particular pay period. So I guess they just use that for data collection. Gross wages, how much income tax was withheld, okay, in this example, they're giving you the Social Security wages and the Medicare wages. I guess we can assume that nobody was over that $160,200 mark with those wages, but you would have to calculate that out. So 12.4% for Social Security to figure out the tax, 2.9%, again, both halves, employer and employee portion of the Medicare wages as well. They pay on a semi-monthly basis, $50,000 per pay period. Okay, so they can be semi-monthly, yeah. Deposits for the quarter were $69,800. So they've given us an example form of the 941 that would be filled out. So here are the calculations for the Social Security tax. This is per pay period. And this works really well when you've just got salaries and they don't vary at all. Of course, in reality, a lot of times that's not going to be the case. Or is this, so 50,000? Okay, so this is the quarter end. I don't know where the 50,000 is coming from. Oh, per payroll tax per payroll, $50,000 liability, and then they collected $4,000 of income tax per pay period, and they're semi-monthly, so okay, so that's where that comes from. 2 pays per month, 3 months, that's where the $300,000 comes from. So total tax liability for the quarter was $69,900, but they made deposits of $69,800. I do not know how that could happen. So they deposited $100 with the return. They'll probably get a penalty for that because it's late. Like I said, normally you're not going to have, normally those are going to come out almost exactly the same. There's a place on the form, if you recall, that adjustment for fractions of cents, where if it's just due to rounding, you essentially force it to match what your deposits were. But usually payroll is pretty right on the money, so that's kind of unusual. But anyway, so here's the 941 form. You use this for all 4 quarters, but then you check off which quarter you're filing for. All the identifying information there. There's where the 6 goes. Wages, tips, other compensation, that $300,000 for the entire quarter. $24,000 in total was withheld for federal income taxes. There's the $300,000 of wages for Medicare and Social Security. Again, we're assuming that nobody reached that $160,200 threshold. Multiplied by 12.4%, so this is both halves, employer and employee half of the Social Security tax. Down here, multiplied by 2.9%, so both halves of the Medicare tax, to calculate those out. And then over here, line 5E is the total of these columns. Line 6 is the total of the 45.9 plus the amount of federal income taxes that were withheld, 69.9, and then where did they get the deposits? Oh, okay, so the second page here, they're going to show how much was deposited, 69,800, showing that they still owe $100. Like I said, I don't know how that happened. And then the last page, which is just the signature and everything. Now, because they're a semi-weekly depositor, they also have to fill out this form Schedule B. On the form Schedule B, so here's our calendar year. So this is used for multiple years. And then again, we're gonna check off which quarter we're referring to. We indicate, so just read through this so you can use the schedule to show your tax liability for the quarter. Don't use it to show your deposits. This would correspond to the days that they were paid, right? The IRS will use this to make sure that you paid on time. So if you are a semi-weekly depositor and you paid on the 15th, but you paid your employees on the 15th, but you didn't pay the IRS until, like, they know when you paid them on the 25th, they know you're late, right? So this is one of the ways that they tell that. So you tell them how much you owed and the date that liability was established. That's the pay date, right? So for each of the months, you would do that. So month 1, in this case, is January, February. So on here, they paid on the 15th and the 28th. Here they paid the 15th and the 31st. So obviously they pay on the 15th and the last day of the month, 15th and the 31st. Again, tax liability, all of that's totaled. And then that's the amount then again that goes over. Where is it? Let's see. Deposits, where is it? Does it get forwarded? I can't remember. Oh, my muscles start, my arm muscles start to. It's a little bit of a workout. Okay, so must equal line 12 on the form 941. So if you owe an amount, you have to send it with a voucher to explain to them exactly what quarter you're paying for and how much you're paying there as well. Again, so that Schedule B is used to report the payroll tax liability, not the payroll deposits. Like I said, they already know what the payroll deposits are. They've got that information. So they're explaining, sometimes when the total liability will not agree with the calculated amounts, the amount that was paid due to fractions of cents. This is due to rounding. And then there's that adjustment. Difference is recorded on line 7. Usually that's going to be probably less than a quarter, less than 25 cents. Usually it's just a penny or two where there's going to be a difference. And that just occurs because, when you're calculating the withholding for individuals, you're doing it on a per payroll basis and you're doing it per individual. And then when you're calculating the amount that the amount that the employer owes, you're doing it based on the entire payroll, right? Not on an individual basis. So it can get a little bit weird. And plus you're doing the calculation on this form, you're doing it on a quarterly basis. So that's why there can be that difference there. I think that's it. Questions about either of those? No?